It was originally thought that the November 8th U.S. midterm elections should clear up recent political uncertainty for the markets, since stock markets never like any flavor of uncertainty. But now that the midterms are in the rearview mirror, is that what actually ended up happening? Our chief equity strategist and economist, John Blank, is here now with that answer. John, with a lot at stake for investors, and here as we speak on November 17th, we are just learning of the division of power between the House and Senate. What is the takeaway for the market and investors up to this point?
I think the takeaway is we're going to have a Democratic Senate, we're going to have a Republican House, and we're going to have the incumbent remain in the White House. So it's basically a divided Congress, and that should limit the amount of policy that comes through the Congress in the next 2 years. And generally, markets like that.
So, what happens to investor and ultimately market sentiment on this divided government?
I think for the most part, it's already priced in. So we saw the rally to the 4,000 level on the better inflation reading, but also on the prospects of limited additional fiscal spending, which would drive up the consumer price inflation rate. So I think basically it's all priced in now on the November the 17th as we talk.
Does that mean that you don't see a divided government doing anything to help inflation and the economy?
I think it will help it in the sense it won't pass bills to spend, and that is helpful to inflation and the economy. At the end of the day, it's all about the Fed for 2023.
Okay, besides here in the U.S., major politics globally have made it to the top of the world's financial agenda. A major event being the United Nations Conference of the Parties in Egypt. And you wrote recently that that's a generic phrase in international relations speak, meaning a committee created after an international treaty is signed and tasked with making decisions about how that treaty is implemented. So how does the outcome there impact markets globally?
Well, I think, this was COP27 in Egypt we're talking about. I think the biggest news is we have finally passed climate change legislation in the United States and had the president sign it, and then had the president go to that conference with that in hand. So he got us back in the Paris Climate Accords, and he has real negotiating leverage because he has a real climate bill in hand in the United States. So that was probably the most productive climate emissions reduction movement in a number of years for the world, and that's the good news here.
And back here in the United States, even though our elections may still have investors a bit edgy, historically here, excluding the Great Depression in 1929, published data shows some of the best annual market returns have been when the sitting president did not have full control over both houses of Congress. Do you see that being the case as it progresses here?
Actually, I do not, Terry. I do think we're going to have to wait till we get the Fed out of the way in 2023. And until that happens, or if that happens, then we really will see the typical response. But it might be delayed, or at least, the introduction of a Fed tightening cycle right now is really the major thing that's going on. I think this midterm thing will, be marked up for the data books and the historians to look at. But at the end of the day, I'd pay attention to the Fed.
So going into year's end here, then, it's accurate to say the market is more concerned about the economy and inflation?
Absolutely. And they're including both of economy and inflation concerns only insofar as the Fed, which is data dependent and under a statute to manage inflation to 2% expected inflation, has to raise rates. So the typical thing to understand here is when you have a PCE, a personal consumption expenditure rate at 4.6 or 4.5, 1% on top of that is typically where the Fed ends up. That's 5.5% next year on the Fed funds rate.
We've had a bit of a market rally here recently. Is it time then for investors to take profits out of the rally or put fresh money to work?
My fair value at the end of the year is 4,070, and I think this market barely got over 4,000 this week and then headed back down. Anytime you get over 4,000 through the month of December and the last pieces of November, I think it's probably a good time to take profits.
Along those lines, the current Zacks industry ranks offer just one very attractive sector, and that's energy. Financials have slid to attractive, and in the top third of sectors, healthcare stays at a market weight. So stocks you're looking at in those sectors include Halliburton, LPL Financial, and Medpace Holdings.
Yeah, let's go through this. Halliburton's the number one stock on our list. It's got a beat for growth. This is a stock that has done extremely well from the lows in late September to now. It's about $38 a share. If you want a stock to take profits on, this is probably one. I don't think it's going to go any further. But you got to like a stock that stays with number one ranks, and it definitely worked the last month or so. LPL Financial, again, the number one stock, but this time with an A for growth, much better than Halliburton. And actually, this stock is down at the lows of recent times. So you got to like this stock's probably in a better shape than Halliburton as a buy, and the PEG ratio here is 0.37, which is extremely low for a stock. Medpace Holdings, ticker MEDP. You probably don't know this stock. This is a contract clinical research organization for biotech, pharma, and medical devices. So you basically pay these people to clean up your work. A for growth and a 1 for the Zacks rank. Again, the stock's taken off. It's $220 a share as we talk, actually $216. And back in October, it was $160. So definitely probably want to wait on this one to pick it up. But talking about a stock that's doing well on an earnings beat, it's Medpace Holdings.
Our chief equity strategist and economist, John Blank, on the markets. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.